Good morning, David. There he is.
Morning, James.
Thank you very much for doing this. I don't know if we've had you on before, so as we normally say with our guests, maybe you could start off by introducing what the fund is trying to achieve, please. I know there's a few kind of disclaimer things that I should be showing first. So I don't know if you can read this. Maybe you want to capture the screen and come back to it. We'll look at it on the recording. There we go. There's that one. Now, over to you. Tell us a bit about the fund, please.
Excellent. Thanks, James. So Octopus Renewables Infrastructure Trust, or ORIT, was launched back in late 2019 with a very successful IPO, raising £350 million. And what we're trying to do within ORIT is to give investors an attractive level of return, mostly through paying out a dividend, but also to give an additional element of capital growth. And I'll come on to how that works in a minute. So we're focused on renewable energy assets, particularly wind and solar generation in the UK, wider Europe and Australia. And we're aiming to deliver investors a 7 to 8% net return per annum over the medium to long term. If you look at what's happened over the 3.5 years or so since IPO, we've delivered a really successful portfolio. We've got a portfolio now of 919 megawatts, either in construction or operation, across 7 countries in Europe. We've had 2 successful fundraisers since IPO. So the market cap of ORIT is now roughly £600 million. We've been paying out dividends in line with our IPO targets for the first couple of years. And then since then, we've increased the dividend in line with either CPIH or CPI over the last 2 years. So we recently announced, or the board recently announced, an increase in the dividend target for this coming financial year ending December 2023 to 5.79 pence per share. And that represents a 10.5% increase compared with the 2022 dividend. So in line with CPI for the year. And we really recognise how important that inflation protection is to investors. And the board has been comfortable increasing the dividend in line with inflation because of the strong dividend cover that we've got now from the operational assets. We had a 1.8 times covered dividend for the half year at June. And when our full year numbers come out in a few weeks time, you'll be able to see again the strength of the dividend cover. Just before Christmas, ORIT entered the FTSE 250 less than 3 years after the IPO. So that was really pleasing for the team, and I think also brings greater liquidity to the shares, which is always good for investors. Looking at that portfolio of 919 megawatts, which I'll dig into in a bit more detail in a few slides' time. The value of that on a gross basis, including the debt associated with it, will be 1.3 billion once we've finished building all the projects we're currently building and followed through on all our commitments. And one important thing to note is we don't have any unfunded commitments whatsoever. We've recently extended the maturity of our debt facilities out for another 3 years, and so our construction and acquisition commitments are all fully funded by that RCF facility. On the right hand side of this slide, we've got a few things that we think set ORIT apart from what, as James has said, is a fairly crowded sector now in the renewables space. So ORIT was set up only 3 years ago, but the team at Octopus Energy Generation, where I sit, has been in this space now for about 12 years. And it's grown to be a really big team over that time. We've got over 100 people in the team. And that's not just people with finance backgrounds. We've got a lot of real energy sector specialists, people who've worked at turbine manufacturers, at construction companies, within the utilities. Now, have got real hands-on experience in managing these energy assets. And that's what enables us to do what we do, particularly, as we'll come on to, in delivering assets through construction. The next couple of points are why we think ORIT is quite different from a lot of the peer group. So we were set up day one to deliver diversification within the renewables sector. So we never wanted to be a single technology, single country fund. We wanted to deliver a mix of solar and wind, and we want to have diversification across geographies. Again, I'll come on in the next couple of slides as to why that's important. Next point as to why we're different is that we didn't want to be a yield co. So when you're looking at the yield you can get off these sort of products, we agree that there's some attractive yield there. But if you're just sat on a portfolio of operational assets, now that ultimately is a finite life asset. They're not necessarily going to run forever, and so your NAV will start declining over time. We don't want to be that sort of pure yield co. So what we can do by going into assets at the construction stage, we can deliver NAV growth through de-risking that construction, and that helps NAV. It helps avoid those NAV declines in the longer term. So we can keep paying out an attractive dividend that keeps growing, but we can also maintain and grow NAV through that construction allocation. A couple of years ago, we had a slight change to the mandate to allow us to invest in developers. Only 5% of gross asset value that we can do into developers. So that's people who are working on these renewable energy assets before they're ready to start construction. So securing a grid connection, securing all the planning permissions and all the land rights you need. And we really like that because it gives proprietary pipeline that ORIT then has the option to invest into when the projects are ready to build, but isn't required to. So we can secure what we think are really good value deals, but without having to make substantial commitments too early in the project life. And finally, on this slide, ORIT is an impact fund, and we embed impact and ESG throughout all of our investment processes. We're an SFDR Article 9 product, and we expect when the sort of the UK new sustainable disclosure regimes has also been bottomed out, we'd expect to be a sustainable impact product under those new rules as well. So the next few slides, if we can move on to the next ones, just give a little bit more colour on those key differentiators. So you can see my face on this slide, but you can also see some of the wider team that work on ORIT on a day-to-day basis. I co-manage the fund with Chris Gaydon, but we've also got a wider team dedicated to ORIT, as well as having access to that team of over 100 people that I mentioned earlier, who've really got the dirt under their fingernails from building these assets, or have got the experience from working in utilities and power market advisors actually trading the power. So we've got that depth of expertise, and that's particularly important, as I say, when we're doing those slightly different things around construction, which really require that expertise to do well. If we move on then to the next slide, this gives a little bit more background on why we think diversification is just as important within the renewables sector as it is when investing more generally. We've focused on wind and solar as our core technologies, with at least 80% of the portfolio going into those. And we think those are the two technologies that are going to be the backbone of our power systems as we move forward into the new decarbonised world. So that's where there's the most opportunity. The reason we like having wind and solar together is there's actually a natural anti-correlation between their generation. Not only is it obviously more sunny and more solar generation in the summer, but also wind tends to be more weighted towards the winter. So it smooths out your cash flows over the year. But also when you're looking year to year, we've seen, for example, over the last year or two, lower than average wind speeds, particularly in Northern Europe. However, we've seen higher than average solar production, and that pattern, if you look back through the historical data, there's genuine anti-correlation there, which just helps reduce risk within the fund. We do look at some other technologies. We've got that up to 20% we can look at in other technologies, and at the moment, the areas we're most interested in there are in battery storage and potentially green hydrogen, which is another developing technology that we think is really an important part of the broader energy transition and quite complementary to renewable generation, just as battery storage is. On the geographical side of things, there's that same risk management approach. So if you have a year where it's less windy than average, say in the UK, you wouldn't expect to have the same pattern of wind speeds necessarily in Southern Europe or up in the Nordics. So by having assets spread over a greater area, you reduce those concentrations of risk to weather pattern. But we also think having that broad mandate geographically and the team that's able to originate and execute across the full breadth of that mandate because of the depth of experience and the depth of industry relationships, that really gives greater opportunity for growing the fund and growing it well. So we're not in a position where in order to grow, we almost have to win every deal that comes to market in our individual geography. Because we're able to look across the whole of Europe and indeed Australia, we can see where there's best value, and we can also see where a government's doing the best job of incentivizing new renewables, the best job of dealing with some of those issues around grid connections that Andrew touched on earlier, and therefore capture the most opportunity and the best value for investors. Moving on then to the construction side of things and why we do that. As I touched on before, we really didn't want to sit there with a pure yieldco type structure. And by going in at the construction stage, one, we're helping decarbonisation that bit more by actually bringing new green generation onto the grid. But from an investor point of view, we're delivering NAV growth, because when we're valuing these assets using a discounted cash flow, we will have a higher discount rate for a construction asset to reflect that there are some risks that go with construction. We've got the team to manage those risks. On the bottom right of this slide, there's some figures around the track record of the team over the decade or more we've been going, and they successfully built almost £2.5 billion worth of assets across Europe and Australia, and on average those have actually come in slightly under budget. So we've got the ability to manage these construction sites well. We've done that within ORIT on 4 wind farms so far, 1 in Sweden, 2 in Poland and 1 in France. And we've got therefore 131 megawatts of the 919 that we've managed the construction, with a further over 120 megawatts coming through later this year. As I said, the reason we do that is because it's delivering additional NAV growth. We've delivered over £12 million of NAV uplift just through removing that construction risk premium from the discount rates through time. And that's with the Cumberhead wind farm and the Breach solar farm not yet complete. So more of that yet to come. So finally, on the sort of sorry, a couple more slides on sort of those key differentiators before I give a bit more color on the portfolio that we've built. And these are the development stage investments. As I say, we do this for 2 reasons. One is going into those earlier stage investments gives us an opportunity to deliver higher returns. We only want to do that with a very small part of the portfolio because it does come with extra risk as well. But the other really important reason for these development stage investments is it gives us that access to future pipeline where we've got preferential rights to fund the construction. We've backed 3 development stage investments so far. I won't go into every single one of them in detail in the interest of time, but one perhaps to flag here is Simply Blue. So that is an Irish-based developer of floating offshore wind. So this is what we see as the next generation and how the world is going to evolve in the wind industry right across the world. If you think about where the most growth in wind has come over the last 5 years or so, it's absolutely been offshore, but in offshore wind farms that are directly in the seabed. But there's only so much seabed that's shallow enough to do that in a cost-effective way. And if we're going to be successful in delivering on net zero, we just need more. Floating is the answer to that, because you're then not constrained by seabed depth. And this is not new technology. This is technology that's effectively been used in the oil and gas industry for decades. It's technology that's already being used. So there are full-scale examples of floating offshore wind turbines out there right now. There's one off the coast of Aberdeenshire, for example. Really what needs to happen over the next 5 to 10 years is just bringing the cost of implementing that technology down through economies of scale, through supply chain. And in Simply Blue, we found a developer that's quickly, since we invested, become a world leader in this space. So we're really excited about this one and the opportunities, both for value growth and for further attractive deployment that may come in the future. Finally, then on the next slide, on those differentiators, if we click on, is the impact side of things. So we position ORIT as an impact fund because we are delivering that new generation through the development and construction stage activities. But importantly, we don't see impact or ESG as being any sort of cost to investors or coming with any sort of financial trade-off. And one of the reasons for that is when we're looking at these investments, we're applying ESG because we think it's really solid risk management. It helps us screen out assets that are at higher risk of running into problems, perhaps because of challenges from the local community, because the developer hasn't done things in the right way, challenges from environmental groups because actually the site's causing more harm than it's actually helping. So it's good risk management. We're screening things out. But also because we go above and beyond trying to look after the local environment, add value to the local communities around the sites that we're building, we think there's a real opportunity here. In our valuations, we assume these things work for 30, 40 years, and then we have to spend money taking them down. But in reality, we expect that there's a lot of these sites that can get repowered or extended over the years. And if we've been good corporate citizens along the way, then we've got a far higher chance of capturing that opportunity and delivering that extra value for investors. I've got a couple of slides now just on the portfolio so you can see how that 919 megawatts is built up. The purple countries on the right-hand side here hopefully give a sense of the diversification point that I was touching on earlier. Our assets are spread out across Europe, so not concentrated to any individual country's weather patterns. The other really important thing that I want to draw out on this slide is just how we go about finding these opportunities. So what we really don't like doing is buying assets in highly competitive auction type processes where a seller has appointed a bank or a big four corporate finance team to canvass the whole market, drive a really competitive process and extract every sort of pound of value they can for the seller. All but one of these deals have come in processes that don't look anything like that. Either it's been a bilateral opportunity that we've been able to originate from our strong relationships, or it's a process where a developer has been running a sales process themselves and gone out to a handful of counterparties that they know and trust because they've worked with them before. And the only one opportunity, investment on this portfolio where we have been in one of those highly competed advisor-led processes, we actually found out after the fact that we weren't the highest bidder on price in that process. Even then, we won the deal because of our credibility and the strength of our team in giving confidence to the seller that we'd actually deliver the site and get the deal done. The next slide just gives a bit of a sense of what's coming next. So we've talked about the construction side of things. You can see that the Cumberhead wind farm there is getting very close to the end of construction. We've actually got all 12 of 12 turbines installed. So the heavy lifting's done, and we're really now just focused on the commissioning, the final tests and checks that are needed to bring that site into full operations. And then later on this year, we should have the same happening for the Breach Solar site in Cambridgeshire. So people are on the ground now, putting the piles in to support the panels. Panels are going to start arriving on site in the next few weeks, and we're well on track for full operation of that site towards the end of the summer. You can also see on the bottom of this slide that we've got a couple of conditional acquisitions or forward purchase type transactions. One in Spain, where we will acquire a large portfolio of sites in southern Spain. If the developer is successful on getting them to a ready to build stage, that means getting effectively all the final environmental and planning permits that they need from the Spanish authorities. And then the bottom one is a large portfolio of sites just on the outskirts of Dublin in Ireland. Those are currently being built, actually just starting to be energized, and we'll acquire those once the site's fully constructed, probably around the middle of the year. So I've got just one final slide now summing up what I've run through there. you can, I suppose there's been a lot of noise in the energy sector over the last year with very high prices, some uncertainty about how governments are going to deal with that. We think that uncertainty is largely past. Governments have announced their windfall taxes or price caps, and we've got the team available now to really seize on the tailwinds in the renewables sector, which we view as being as strong as they ever have, because building wind and solar is now not just the answer to net zero and decarbonisation, but it's also the answer to energy security and getting ourselves further away from reliance on things like Russian gas. And also it's the solution to the energy cost crisis, because wind and solar are the cheapest forms of electricity generation. So ORIT's got that diversification, which we think is crucial from a risk management point of view. We can deliver additional NAV growth through the construction activities. We've got access to proprietary pipeline through the developer investments, and we're delivering impact and ESG as well.
Great, thank you very much for that. That's just a good summary of what's going on. We've got quite a few questions coming through, so let's get some of these answered. First of all, there's a couple of questions around the sort of balance of the portfolio between operational construction. So I think this one's saying 70-30 operational construction. Does that ring true for you?
So that's where we want to be, actually. It's about 70-30 in terms of, I suppose, value of the portfolio. Actually, by Q4, on a sort of gross value basis, we were starting to get a bit lower than that, so more like 18% in construction. Given the size of the operational portfolio, we think we can give a strong dividend cover and a growing dividend, and still have about 30% of the portfolio in construction. So that's where we want to be. Clearly, if we get to the end of this year and the markets haven't sort of reopened to equity issuance, then we would, all else being equal, being fully operational. We don't want to do that. So we're actually actively considering whether, for example, we could recycle capital out of projects that we've built, maybe by selling a minority stake in those projects, and then reinvest into construction assets to keep that 70-30 split.
Yeah, that was my next question really, is whether you'd actually sell stuff. So you haven't sold anything so far, have you?
We haven't, no. I'm not sure there's many in the sector who have, but it's something we said right from IPO, is that we want to be an active manager. We don't want to sit there on a fully operational portfolio. Clearly, if we can grow the construction allocation through equity issuance, and that's NAV accretive to existing shareholders, then that's a preferred option. But if that option's not there, then absolutely we would consider asset sales.
And is it important, you talked about selling minorities, is it important to have a sort of controlling interest in these things?
So we are a very active hands-on manager. So we don't want to just have passive financial stakes. Really, the closest example we have of that is the stake we've got in the Links offshore wind farm. We thought that made sense because it was delivering attractive yield, and was also the first investment we've made in the offshore sector. So it's good learnings being sat alongside the likes of Ørsted and Macquarie in an asset like that. But if you look at the operational construction sites we've got beyond that, we've got a 100% or a majority in all the rest of those, because we do want to be in control of the construction. We want to be in control of the contracting. We want to get the most value from that large team that we've got and the expertise within it.
And there's a question here about the sort of timescales in terms of like how long it takes to get a project from sort of conception to operational profitable. Is it? I'm guessing it sort of varies by project. Can you give us sort of like a steer as to how it works? Yeah,
it can vary. You can see from here the Ljungbyholm wind farm went from first shovels in the ground to fully operational in about 15 months, and that's pretty good for a project of its size in wind. But 15, 18, 24 months for a wind farm wouldn't be unusual. Solar construction can be a bit shorter, particularly if it's a smaller site. Where you get the real variation is in how long the development takes, and how long it takes to get access to the grid. That for a developer starting out, it can be 7 to 10 years until the thing's ready to build potentially. because of all of the environmental studies and some of the delays in grid access. But no, equally, you can shorten that if you can find the right projects in the right places.
Cool, thank you. There's a question around the sort of balance of the portfolio between things like wind and solar and the extent to which you might want to do. So I think you said at the moment there's a 20% you've got permitted to do in things that aren't wind and solar.
Yeah.
Do you think that's hard and fast forever, or is that something that you think you're going to persist with?
There's certainly no plans to change that 20%. We are focused on renewable generation. We think that's where there's still a huge opportunity and a huge need for more wind and solar generation to be built. But we do recognise that there are complementary technologies that are going to be needed alongside that, and that's what that 20% allocation is for. Say no plans to change that. One thing I didn't mention actually on this slide, which I should have done, is there are a few other people out there who talk about being a diversified renewables fund. We think you'd struggle actually when you look at the numbers to find any of the other scale players that have got the level of diversification we have, either between wind and solar or geographically. So it's quite important to look at the underlying numbers and not just the headline on that.
Cool, fair enough. So in terms of sort of new technology you might look at, I mean, our guest last week was talking about the role that nuclear might play. Is that sort of beyond the sort of scale of things you might look at?
It's just not something we're interested in. I think nuclear, it can be quite a controversial topic. Our view is that for the scale of nuclear plant that we could look at, some of these small modular reactors, for example, that people are talking about building, they're still just too far off into the future for us to be worried about right now. No, it's not something that's going to be happening in the next few years, and there's more than enough for us to be going after in the wind and solar space in that period that we just don't need to distract ourselves.
Fair enough. And in terms of geographic diversification, would you look at the US?
Again, no sort of immediate plans in terms of ORIT. Actually, the wider Octopus Energy Generation team has got people on the ground now in the US. It is, if I suppose, if you look at our mandate being Europe and Australia, there's plenty to do there, but the US is such a big market, it's hard to ignore. So it's an area that the wider team is looking at, building up our expertise. A number of people in the team, myself included, have done renewables in the US in past lives. So yeah, never say never. It's just such a huge market and a huge opportunity. It is hard to ignore.
Fair enough. In terms of sort of onshore versus offshore, I was wondering whether if you got Simply Blue there, are you sort of agreed to finance some of their projects, or is that not the way the model works?
So the funding we provided is for them to be doing the early stage development of projects. So where they've really set themselves out as a leader in the industry is in that early work, identifying sites, doing the work needed to secure the rights to the sites. The scale of these projects is such that then bringing those sites through to being ready to build is quite capital intensive. And so the funding we provided will let them get a certain way along that journey. But what they've done historically is once they've secured a particular site, they will then bring in a strategic partner. They've got partnerships with the likes of Total Energies and historically Shell and Ørsted. So they're bringing in some of the big either oil and gas or offshore wind construction specialists to do that really capital intensive stuff nearer to the project being ready to build. But we would expect, I suppose, given that some of these projects are probably 5-7 years away from being ready to build, that hopefully the company will have grown, or it will have grown sufficiently in the intervening period that we can start looking at backing some of those sites.
Okay, thank you. Just in terms of the mechanics of it, because there's a question here about, I guess it's really about valuations, but the question is actually saying, do you depreciate your assets on a sort of straight line basis?
Yeah, that's quite hard to answer actually without getting pretty technical on how the sort of discounted cash flows work. So the way we're valuing these is with a discounted cash flow model that goes out for 30 or 40 years, depending on, or less if the asset's only got shorter leases. how the NAV evolves over that period really depends on the shape of those cash flows. So if you've got, for example, an asset that maybe an older asset like the UK's rock assets or the French solar assets that have got a sort of legacy subsidy from 8-10 years ago, those receive quite high revenues for the first 20 years, and then the revenues step down. So what you'll see is that it's throwing off income, but the NAV stays quite flat to start with, and then will start trailing off as you get nearer the end of the subsidy. Just as the fact that you're getting nearer the future cash flows makes the value go up, but the fact that there's fewer years left makes the NAV go down, and there's a crossover point where one outweighs the other. For some of the more modern assets which aren't receiving any kind of subsidy, you actually can see NAVs increase over the first few years, depending on the shape of the revenue forecast and the power price curve. But it's not really a subjective choice of depreciation. It's more mechanical on just how the discount rate working through the cash flow model works.
Fair enough. Thank you. Breach Solar, you announced this morning, so that's got a 10-year power purchase agreement, which is a lot longer than most of the PPAs that we've seen in the UK sector. Do you think that's a trend that's going to happen more and more?
With the corporate PPAs, 10 years is quite commonplace. I suppose what's been the case is it's been a relatively slow and long journey for the corporate PPA market to really open up. But yes, we are really seeing an increase in demand from corporates to enter into long-term contracts like the one we announced this morning with Iceland. I think because there's more and more of them who are seeing the high prices that we've experienced over the last year or so, where some of them might have had hedges in place, but those hedges are coming to an end. They're seeing that the prices are expected to remain pretty high for the next few years. So if they can dampen some of that by entering into a long-term contract where we sort of reduce the price in the near term, but the trade-off is they're paying perhaps a higher price than they might have forecast 5 to 10 years down the line, that just really helps their cash flow in the short term, as well as obviously helping their green credentials. And a lot of corporates are on a journey to net zero themselves. So yeah, we're really seeing an increased appetite for contracts like that over the last 6 months or so.
There's a question here actually about maybe the direction of power prices, which is, I think, the implication of it, which is that maybe the lower power prices that we've got now may be temporary, because we depends on what factors are really causing the power prices to be lower than they were a year ago. But on balance, do you prefer to have exposure to fluctuating power prices and maybe capture some higher prices in the future, or would you prefer to fix more and more of the portfolio so that you've got more visibility about your revenues?
So we like a balance. We don't think that what we have offered to investors is sort of naked exposure to power prices. We think that would bring too much volatility and ought to command a higher return. So we've got over 2/3 of our forecast revenues fixed for the next 2 years, a similar level of fixing going out right for the next 9-10 years or so. And we think that gives a good balance between certainty of revenue and therefore confidence in the dividend cover, but also gives some flexibility with that remaining sort of third or so that's not fixed for us to see where there is and isn't value. So because we're not trying to fully hedge the power prices, we're not having to trade value for certainty. We can strike what we see as the right balance, and we say we've got within the team a number of energy market specialists working full time on making those judgments and being in the market to see where there is and isn't value.
One last question before we go. I know we're nudging on 12 o'clock now, but do you have a view on what you think has caused the discounts to widen generally and yours specifically?
So I think there's a bit of it that's just been around. If you look at when the drops happened, it was really around the mini budget back in September. And so I think there are some investors who've looked at the yields in the sector versus maybe bond yields and perhaps think there's other ways of getting income. So our view on that is that, you know, our income is, as I think either you or Andrew touched on earlier, there's genuine inflation linkage within our portfolio. And so maybe a comparison to real bond yields rather than nominal bond yields gives a slightly different picture. So we think that will work its way through, and the sector will come back to a premium, just because the structural trends behind it are so strong. The tailwinds for renewables investment really strong, and perhaps if people look a bit closer as to where they're only getting yield, where they are and aren't getting inflation linkage, and compare that to where they can get yield plus a bit more growth, then maybe you'll start to see a bit more differentiation within the sector.
Yeah, thank you. I think that's really helpful. That's a good place to stop, I think. So thank you very much, David. That's quite interesting. And we'll definitely get you back on again in a year or so and just see how things have been going, if that's all right.
Yeah. Thank you for having me. Yeah, very, very happy to.
Good, thank you. We will be back next week talking to VH Global Sustainable Opportunities, so another remuneration fund that with slightly different market exposures to octopuses, so that should be interesting. And then the week after, we're talking to Whittam, something completely different. And we've now got a sort of full slate all the way through to the end of April. So, but as always, if there's a fund you want to us to talk to, then please do flag it, and we'll endeavour to get them on the show. Thank you for your time this week, and see you next week. Bye bye.